Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I got Jeff and Matt here with me today on our panel. We are talking about the Federal Reserve Committee open market committee meeting today that they were talking about what they're going to do with rates. Ultimately, they've decided to keep rates level, which is interesting to me because of the fact and I think it's interesting to the markets. I'm not going to get too deep into it yet, but going into this year, I think one of the challenges was or is at this point in time the fact that I think the overlying sentiment in the economy was there was going to be 6 rate cuts in 2024. And that was what spurred consumer confidence. That's what spurred the market confidence. And we've seen the market go to record highs, because of this kind of quote unquote sentiment, right? And where we are now, we've just had the meeting minutes today, and Jerome Powell and the group have decided to keep rates level. And therefore, it's another time that people were hoping for rate cuts and didn't get rate cuts. I got to say, this is no surprise to me. But the question is, what does this mean? What does this look like going forward? And what does it mean for you? What does it mean for your wallet? What does it mean for your financial strategies? What does it mean for your investments? How are things going to play out? And the reason I wanted to do this video is because I have a lot of thoughts on this. I've been kind of spending some time doing some deep dive into this, and I think I'm going to share some insights that are probably going to be a little bit different than what anybody else is sharing based on my thoughts. And so stick around, make sure you're here for that. And I'm excited. I'm excited to be able to share it with you guys. And so in the meantime, though, what I'd love to do is start off. I want to hear kind of, now we got Charles joining us as well. The beauty of live video here. Charles is down. It looks like down near the ocean there in California, which is nice. And so we're gonna talk about this. But let's start, Jeff. I'm gonna start with you, buddy.
All right.
Talk to me about what are your thoughts on the fact that we've been talking about these rate cuts all year long. Everybody's been hoping for them, expecting them. Asset prices have been praying for them, and yet nothing's happened.
Yeah, I mean, my thoughts on it are a little more high level on all this kind of stuff. I mean, I think, as I zoom out on this whole topic of the economy and the levers that get pulled and inflation and whatever interest rates are going to be and whatever they're trying to accomplish overall, I know a lot of times they're saying it's to keep the economy going. But I think, what I've learned over the years and observed is there's always the fact that there's powers that be that generally want to kind of mess things up a little bit and keep us disempowered to some level. And so, I think the more things that we can be doing to empower ourselves financially are going to put ourselves in a better position than if we're on our heels waiting for the government to solve our problems by lowering interest rates, doing those things. So, if we're in a position where we need the banks and we need to be, getting capital from the banks, and because interest rates are so high, it puts us on the outside of being able to, get capital. Well, that's in a disempowered position. And if we're waiting around for them to lower interest rates for us to make moves in our business or personally, well, then we're disempowered by that. I think for me, it ultimately goes back to what are you doing under your control that you can do to put yourself in an empowered position. And whatever the factors outside of ourselves are, they're going to be what they're going to be, right? The government, the feds are going to do what they're going to do, whether it's to our advantage, whether it's to keep the economy stimulated, whether it's to purposefully devalue the dollar further. I've seen a couple articles talking about if Trump gets in for a second term, they're going to intentionally crash the dollar further. They're putting that out in headlines in the Wall Street Journal and things. So we know that there's games being played, right? There's always political motives behind a lot of this kind of stuff. So I think at the end of the day, for me, I know that's going on. What can you do to put yourself in the driver's seat and more control over your life and your financial position?
Love it, man. Matt, how about you?
Well, I think there's a lot of discrepancy here, and really, for me, the question is how much of this is just really due to the elections coming up. What do we really need to do as a country versus what are we doing, right? And there's just a lot of discrepancies. I know one of the things that allows the Feds to determine, whether they're going to drop rates or stuff like that is the strength of the economy. So now the question is, well, is the economy strong right now? And you got two camps. And if we look in May, the jobs went up. And so they look at jobs a lot, and the Feds probably assume, oh, the economy is doing great. Well, the jobs went up, but then unemployment is tipping up to 4%. And if you guys don't know, relative, like 4%, in 2020, when that COVID hit and everybody lost their jobs, we teetered up to 4.4% and went up all the way to 14% unemployment. So we're not going in the right direction. So if our economy is strong, then why is unemployment trending upwards? One. And then two, if you see what's happening, like if you look at the data, in the beginning, when this inflation started going steady and we held the inflation, the interest rates and everything, people were continuing to spend money. So with inflation up, how are people coming up with money? Like, why is spending increasing? Well, the Feds are looking at the spending saying, oh, our economy's strong. We still have money. Well, what we find is a lot of people, they were spending, credit cards, pay later programs, savings, they're depleting their retirement. And now what we're seeing is spending is starting to go downwards, and the labor market is kind of softening. And so it's just interesting how I'm just curious to see what the Feds see to say, oh, no, we're fine. We're just going to keep, everything here. And then when you see all the other stuff, there's kind of things that just don't look right. And it's just, do you really trust them? No, I don't. I mean, you could pick your own opinion, but I think there's just a lot of things at play. Elections coming up. There's a lot of people that they have to appease. And ultimately, it's just not helping us. If we were to zoom out and really look at it, I think I follow a lot of smart people, and they say we're in a big super bubble where this bubble was actually generated a long time ago. And all we've been doing is just kicking the can down the road. And at some point in time, it's either now or later, it's going to come down. And unfortunately, we're the innocent bystanders with all this stuff that's happening.
Love it. Yeah, no, I mean, I think I'm kind of in that camp. I mean, ever since 2008, 2009, when we did all the things we did to get ourselves out of that mess of the Great Recession, and then we look at quantitative easing 1, quantitative easing 2, 3, so on and so forth. Then all the monetary policy over the past decade, and then COVID, and then the bailouts of that, and all the stimulus and money printing and everything that goes with that. It's been there. I don't think it's hard to see that this is a bubble that's been inflated. You touched on some things, both of you did, that I think are, to me, super important. I think Jerome Powell right now, I don't envy this guy, because he's sitting in a spot where he kind of inherited this just this dumpster fire, right? Like it's our economy and the monetary policy and everything is just, it's quite frankly, it's just a dumpster fire. It's horrible. And I really think he's doing the best he can, he's trying to do the best he can. And so that said, you look at, like, what are the indicators that the federal chair committee looks, what are the indicators that they look at to be able to make their decisions, whether to raise rates or lower rates? Well, I mean, I think the highest level one to look at is just, what's the inflation rate? And a lot of people are thinking, well, inflation is under control because of the fact that, it was at 9 and now it's at like 3.4. And that actually, by the way, last month, inflation ticked back up 0.1% higher. So it's actually keeping levels, the rates level, inflation's ticking back up, right? So what's happening is Jerome Powell's looking at this being like, all right, inflation is going up even with level rates. And so if I reduce rates, it's going to go out of control again, right? Like, we can't reduce rates if it's going to undermine the value of our currency. Now, the one thing that I think is interesting, everybody is talking, and here's what this is where I may differ from a lot of people. But I've been doing some research on this over the past week. And one of the things, and I'm not going to sit here and tell you that I have this like hardcore theory that is like worked out fully or anything of that nature. But I do want to share some stuff that I've seen and some thoughts that I've had as I've gone through it, because I think it's relevant. I think I think it's going to be an interesting dynamic here in the economy. So one of the things now, if everybody, little history lesson for everybody. Back in 1944, there was this thing called Bretton Woods Act in Bretton Woods, New Hampshire. There was this big meeting of basically the World Economic Forum, and they named the United States the world's reserve currency. So everybody knows we have the world's reserve currency status as a country. Well, that happened in 1944 due to the Bretton Woods Act. And so with the Bretton Woods Act, ever since that time when we had the world's reserve currency, that basically means, what does that mean? That means every other currency in the world is compared in value to the US dollar, right? So when I travel to the Dominican Republic, when I go to South America, when I go to Europe, when I go to wherever we go, every value of currency, granted we can compare everything to everything, but like the US dollar is the stalwart. It is the pillar currency that everybody compares everything to. So what happens is all of these other, like our decisions have an impact on every country, whatever we decide to do. So people don't realize this, I feel like, but whatever we do impacts the rest of the world, because our decisions, the decisions that the Federal Reserve is making right now. I'm with Bob Hastings right now. Yes, that's awesome. Love it, Braden. That's amazing. So when we're talking about, like, our status as the world's reserve currency, what happens is we look at the fact that when we change our policy, like Jerome Powell is looking at what's going on in our economy. What are unemployment numbers? What is our inflation? What do the job numbers look like last month? What are the projections for this coming month? What are the core inflation numbers? What are the manufacturing inflation numbers? Like there's all these economic indicators that they're taking a look at. And the problem with that is we're looking at just our country, and that has this tidal wave effect that goes across the globe, right? Because every other central bank leader effectively has to look at us and wait for us to make a decision. So what's been happening, and this is where it gets really interesting, is what's been happening is all these other countries, not all of them, but a lot of them, have been watching us being like, all right, come on, pal, like, let's go. Let's lower these rates. Let's lower these rates. We're ready to lower these rates, right? Because our economies are ready. Like a lot of these other countries, they're like, we gotta start lowering rates. Otherwise, we're gonna go into a recession or a depression or something. Something bad's gonna happen. Like the European Union, they're like, we gotta cut. Canada, we gotta cut. And Jerome Powell's like, nah, not quite time, right? So what's happening is these countries and these, in Europe is like obviously European Central Bank is a bunch of countries, but like all these countries together, they're literally waiting for us. And what happens though is that we're fighting inflation, right? And that's why, make no mistake about it, this is fiat currency at its finest, the elastic currency of the Keynesian economics here that we have is the fact that when inflation gets high, you increase rates, and when inflation gets back lower, or when the economy gets rough, you lower rates, and it's supposed to stimulate the economy and inject more money into the economy. And the problem is we've never been here before, right? We've never been in a situation where the stock market's gone down, that bonds have lost money. That never happened once. It happened 2 years in a row. The yield curve has been inverted now. By the way, when we have an inverted yield curve, 100% of the time historically, we've gone into a recession. Now, I know a lot of people watching will argue and say we're in recession technically and whatever, but technically speaking, even though I would agree, like from a common sense perspective, I would agree we're in recession. But from a technical perspective, the powers that be will tell us that we're not in a recession. So I don't want to have that argument on this video. That's not the purpose of this talk. But we're not in a recession technically. So the question is, a lot of people are saying that, that the inverted yield curve metric is just that it's wrong. It's for the first time in history, it's wrong. I would just say we haven't given enough time yet, first of all. But here's where it's getting really bad. I don't know if everybody knows this because everybody's watching the Federal Reserve. But did you know in the past couple of weeks that Canada has lowered their rates? And the Central Bank of Europe, the European Central Bank, lowered their rates. Okay, so they both dropped them 25 basis points. Not the craziest thing in the world, right? Like it's not the biggest shift in the world. but there's always been like this parallel movement, right? And now what's happening is they're saying, we're out of patience. We can't wait for you. We're going. Now, I don't think that the Federal Reserve is going to be able to lower rates anytime soon, personally. I just don't think it's going to happen. I think people are seriously deluded if they think the United States is going to be able to lower rates. So that said, what happens is these central banks are going to try to lower and lower and lower and lower and lower. So what's the reason that the Federal Reserve is not lowering rates? Because they're trying to fight inflation, right? The idea of having higher rates, I'll argue they're probably going to even have to raise rates a little bit to keep, because last month rates were flat, inflation still went up, right? So that's a problem. And so what happens when Europe and Canada lower their rates again and we keep ours flat? Maybe they have two more drops. What happens when their rates go down from like 5 to 4, 3 3/4, right? 3.75, and we're still at 5 1/4 to 5 1/2. What happens? I'll tell you what happens. It's the worst case scenario. And the reason and it's exactly why we as the United States have been able to have this horrible monetary policy, have this horrible fiscal responsibility. We've been able to outsource our debt to other countries by them buying our bonds. And Matt, I think it was you that said, Saudi Arabia just dumped the petrodollar, just dumped the, they've said, all right, we're done. China's not wanting to play ball, which no surprise, but like the more time goes on, the more people are like, all right, enough's enough. You guys are using your seat of power and you're abusing the rest of the world to finance your own lifestyles and to finance your own country. You're not taking that power and using it for good. You're using it just to be a glutton. That's really what's happening, right?
100%.
And that's what's allowed us guys to have all this debt, have all these unfunded liabilities, and to have all this stuff without feeling the pain, right? In what other world do we have $250 trillion of unfunded liabilities and debt and not feel the pain at all and not seem to be worried at all, right? Like it's because we control everything. That's why, And so, but here's where it gets bad, because Powell's trying to keep rates high to fight inflation because he knows if we dropped it, inflation will go through the roof. But here's where it gets bad. Right now, when these other central banks reduce rates, what's going to happen? What that does when you get lower rates in other countries, and we have the world's reserve currency in the United States with higher rates, which is the foundational asset, what that does is it's going to strengthen the value of the dollar. Because other countries and all the safe money, they're going to be like, whoa, if now in a bond in Canada, I can only get 3.5, but I can get 5.5 or 7 or whatever it is over in the United States, I'm going to just put my money there. And Europe is going to do the same thing. And that's where we're going to have all this influx of money. And so that's going to take all this foreign money, all these international dollars. When Jerome Powell is keeping rates high to try to fight it, we're coming to this place where it's going to be a damned if you do, damned if you don't kind of position. Because unless other central banks kind of lock arms with the Federal Reserve and say, hey, listen, we're with you, bud. We'll take the pain. We'll go along this with you. And we'll keep rates high. If they do that, then okay, that's whatever. But as of last week, they're showing they're not really wanting to do that. They've already reduced. And if they keep reducing, within a couple rate reductions, people are going to start to move money into the United States from foreign countries. That's going to stimulate the economy, which is exactly the opposite of what we want. And I just froze again because my camera is a piece of crap. My new setting here. Okay, I'm sorry, guys. I'm going to have to go to my backup camera, which is not good, but I'll just do it because it is what it is. Here we go. So at the end of the day, if they keep locked arms with the United States and the Federal Reserve, not even the United States, just the Federal Reserve, if these other central banks stay locked with them, then they'll be okay. But if they don't, it's literally going to lead to challenges that we've never seen before. We are in uncharted territories. And what that means is like Canadian savers, European savers are going to dump money into treasury bonds with the United States. That's going to inject potentially billions of dollars into our economy. And now what's going to happen is all this inflation, he's going to have, like, let's say they keep rates at 5.5%. Yeah. Now we're going to have more money coming in. The whole purpose of keeping them flat is to keep less money from being injected into the economy, right? And so now we're going to do that. So he's going to have to raise rates just to fight the fact that other countries are reducing rates. Mm-hmm. Yeah. And we're going to have these problems, guys. It's like inflation. Mm-hmm. There's no getting out of this. We're going to have an inflationary crisis in which, you know, they inflate the debt away, or we're going to have austerity, and we're going to have cuts, and we're going to have pain, and we're going to have, you know, massive. We're going to have 1981 all over again, where rates have to get jacked up because guys, I mean, all this seems unique. It's not unique. Yeah. This is all. I mean, it's a little unique, but it's not unique in the sense that when you look at countries that are not willing to act boldly enough, and I think I did a video on this 2 years ago, and I was calling for them, like, what they're doing is the challenge is these central bankers, you know, they're in with the politicians and they try to just raise rates just enough because they don't want to damage the economy. And at some point in time, when the economy is built on bullcrap and just false numbers and false narratives and money printing and manipulation, and it's not pure, well, then there's going to be pain at some point in time. And the fact that we've been going through pain now for literally 15 years of manipulation and money printing and trillions and trillions and trillions of dollars, like literally more money printing from 2009 to today than the rest of history combined. Think about that. Guys, we talk about the power of compounding interest when we're saving money. Well, It goes against us, right? This whole hockey stick growth, right, that we always are aiming for when we're saving money and investing, and, like, you know, we show that. Well, guess what? It works against us for debt too. And so it didn't feel like it was that bad. Now, before you know it, when the debt and the inflation and all these numbers start to get bad and bad and bad, like our national deficit annually right now is like $3.5 trillion.
Yeah, I read that. I read somewhere that the interest payment on our debt surpassed our GDP. Like, wait, then where do you go from there?
You're done. You're done. Like, the only way is to cut. The only way out is pain. Now, I believe, well, I mean, listen, I'm not a doomsdayer. I'm not I don't think the US dollar is going to crash. I think the US dollar is going to be the strongest currency in the world. And I think it's going to be done on purpose. I think it's because of the things that we just said. Like, when the rest of the world struggles, we are the currency. So people put money here for safety. When you go back to 2008, I think it's fair to say we had a pretty bad recession. Our economy sucked. Our real estate prices crashed. Our asset prices crashed. Investments crashed. Whatever. The best performing asset in the world in 2008, 2009 was the US dollar. I don't think people remember that. You know, do you think
now with BRICS, it kind of changes that? Maybe we can't get out of this. So maybe there are some bigger issues that, you know, if people started getting out of the dollar, going into BRICS, with everything that's going on, I think we might even go into some things that historically we've never seen. I don't know. We'll have to see. Be interesting.
I mean, listen, anything's possible. But I believe it's harder to lose it than people realize, because the whole financial system would have to be overhauled, you know, because to change it from the way that it is. And you know, I feel like a lot of people that think it's going to just fail, even though, don't get me wrong, I'm not looking at the economy through rose-colored glasses here, right? Like, I think things are going to get ugly. I think things are going to get hard. I think it's going to be really challenging. And I think what's going to happen, though, is that I don't know what's going to happen, but I think it's going to go one of two directions. We're either going to have that inflationary problem and I think the inflationary direction is looking more and more likely first. And then inflation is typically what happens is we're going to have this because of what I was talking about, no matter what we do, because if we cut rates, which, let's face it, the political powers that be, if they had it in their mind, they'd cut rates and just deal with inflation a little bit and have the economy grow because, perceived reality is there's growth. It doesn't matter. It's harder for the layman person to understand what's going on, right? Whereas if we have austerity and we have cuts and the market crashes, everybody feels it. Everybody knows it. It's in your face. Numbers are down. Life is hard. Even though, when that happened in 1980 and 81 and, throughout history and the Great Depression, when that happened, for instance, it leads to the greatest buildbacks of all time. It's what leads to the greatest opportunity. I mean, like the Great Depression led to the greatest generation, right? Which is like, it's like, these are the things, like nobody wants to go through the Depression, obviously. That would suck. I just watched a movie, The Cinderella Man, the other day, and like that was all about like that time frame, and I was like looking at it really hard, But I just think that right now, as in the current position that we're in, we're looking at this being like, all right, he's either going to cut rates. Let's think about what he can do and what are the consequences. He cuts rates, and it stimulates the economy. And if the job market gets worse, which it's going to, the numbers are already showing it's getting worse, even though nobody wants to talk about it. But the jobs market is getting worse. Look at savings rates versus credit card debt. Have you seen this?
Oh my gosh,
dude,
yeah.
It's insane.
It's inverted.
It's like totally inverted. It's like they crossed and it's like, whoa, credit card debt up here, saving rates down here. And it's like,
scary.
It is so obvious people are living off of debt right now, and they're living and burning their savings, and they're just kind of hoping it all works out. And eventually that comes to an end 100% of the time. There are indicators. I had John Wolfenbarger from Bull and Bear Profits on the show, and he was awesome. And he was talking about Warren Buffett's favorite metric. And I've done a couple short videos like going through it all. But he's saying that Warren Buffett's favorite metric is showing that the market valuations are at a point where there's a 90% chance that the stock market will be worth 50% less 12 years from now than it is today. Jeez. Now, if that number is true, that's one of the scariest things I've ever heard in my life. It's literally the Great Depression. That's what it is. A little worse than the Great Depression, right? And if that happens, well, then, buckle up. It's going to get real, come down to the Dominican with me. It'll be fun. It literally is, it's scary. But so if they reduce rates, inflation is going to go high, right? And I think we're looking at the scenario right now where I don't think they can reduce rates. But if the economy gets worse, then they're going to have to reduce rates, and they're going to have to just like kind of pray that inflation doesn't get bad. But praying isn't going to do anything. Inflation's going to get bad, if they do that. And so, so if they do that, that's going to be what it is. Right now, like I said, they kept rates flat. Inflation still increased. And right now it's still about 60% higher than target, which it doesn't sound like a lot. It's like 3.4%, which is, I guess, 70% higher than target, 3.4% instead of the target rate of 2, which, I mean, if you understand the rule of 72, that means the value of your money at a 2% inflation rate, the value of your money gets cut in half every 36 years. At a 3.4% inflation rate, let's do it. 3.4% inflation rate, 72 divided by your money gets cut in half. The value of your money, your purchasing power, gets cut in half every 21 years. So that means the difference there is huge, right? Like 36, that's an extra 15 years that you lose a purchasing power between 2 and 3.4. And they're trying to tell us that they got it kind of under control. You know what I mean? Like to me, what does that mean? I'm going to put this in layman terms for everybody. That means if you make $100,000 a year right now, if the inflation rate is 2%, that means you got to be earning $200,000 in 36 years just to maintain your standard of living. That's at 2% inflation. At 3.4% inflation, you need to be earning $200,000 in 21 years, not 36 years. So that's a big difference, right? Now, when we go inflation when it was at 8%, if inflation is at 8%, that means if you're making 100 grand right now, you better be earning 200 grand 9 years from now just to maintain your standard of living. Like this is the inflation, boogeyman that we're all dealing with. And what's happening with rates going up, that means this is why they have to raise rates. And this is at the beginning, the biggest mistake that they made, in my opinion, is when inflation hit. Well, what happened was, I'll say it this way. Inflation went up to, 7%, then 8%, then 9%, right? And what happened was the Federal Reserve was like, all right, we're gonna inflation's at 9 or 7, we're gonna bump up the federal funds rate to 2, or then 2.5, and then it went to 8, and they're like, all right, we got to go to 3. It's at 9, we got to go to 5.5, and they kept it there. And at 5.5, because of other factors in the economy, it started trickling down, but it didn't really solve the problem, right? It just means people kind of became uncertain. They started not spending their money. There were supply chain issues. So, it is what it is. But here's the deal. It didn't solve the problem. You can't, if inflation's at 9% and we're only doing 5.5%, it's still the cost of money is free. It's negative. Because at 9%, that means if you invest money, you need to earn 9% just to keep your purchasing power, just to break even from a cost of living perspective. Think about that, right? So if I could go out and borrow money at 5.5%, for instance, and then go get 10%, well, then there's no balance there. You know what I mean? And this is what Paul Volcker did back in 1980. He literally overnight jacked the federal funds rate from 6% to 19% in one night. Do you imagine if they did that today?
Oh, chaos, rioting, maybe.
But it's what we need. The whole economy needs a punch in the face. You know what I mean? It needs a reset, and somebody needs to have the guts to do it. Really, is what it comes down to, and nobody seems to have the guts to do it, unfortunately. And really, what it comes down to, in my opinion, is we need somebody that's going to be bold. I think we need to raise rates, but the problem that we're lying in right now is that if other countries start cutting, if we're not raising, if right now, let's say in our current scenario, if we need to raise rates to say 8% to solve the problem, and listen, I'm not trying to say this won't come with pain. It will come with pain no matter what, right? But if they raise rates and the economy contracted and we had a 40 or 50% pullback, because let's face it, we got to pull back a long ways from all the stimulus and all the manipulation that we've had, all the quantitative easing that we've had, right? Because nothing in life is free, and everybody's had a free ride in this country, to a great extent. And so if they have to raise rates to 8%, hypothetically, right now, if every other bank starts cutting rates and injecting more money, that 8% is going to have to be 10% or 12% or something higher. You know what I mean? To accomplish the same effect. But the problem is, if we started raising rates, the rest of the world's going to freak out, right? Mm-hmm. And it's also the value of the dollar. These central bankers have this weird mindset where they want to have they want to devalue their currencies. Nobody wants a really strong dollar. To me, if you have a strong dollar, it's really bad for exporting, right? But it's really good for importing because your money buys more goods, right? Yeah. So for the United States, which our our whole economy is based on import. Like, we are an import economy. We don't export much in the United States. So out of all countries, this is kind of like what I've been coming to. I really think there's a play here, and I don't know if that I fully think this, but I've really thought it a lot as I've been like reading all the stuff that I've been reading. I really think there's a play right now that the United States, the Federal Reserve, is on this play where we're just trying to make the US dollar, so strong that we have so much purchasing power around the rest of the world. We don't have to inflate our debt away. We just have so much purchasing power because our dollar will be so strong compared to every other currency, which is so backwards. You know what I mean? Compared to like where I think, but it's like almost this game of like misdirection. You know what I mean? Yeah. And I feel like it's just a matter of time before something like this happens, and I think it's inevitable. And so because of this, though, I don't see the Federal Reserve proactively jacking rates up and increasing them. I think they're either going to lower them, which will be a bad move. They'll keep them flat, and if they keep them flat and other central banks don't stay lockstep with them, which they're not, more money will flood in. It'll lead to inflation problems. Then they'll have to be reactive and kind of reactively increase rates to fight the inflation due to the fact that other countries were not patient and didn't do what they need to do either. And this is because it's all, like you guys said, driven by politics, not actual economics, right? And that's the problem. And so I think it's going to get ugly. And so the question is, what do we do?
Gotta put things more in our control and ride it out.
Yeah.
Control what we can.
Yeah, I mean, I did a video on this. I actually want to find that video real quick. I did a video on this about the value or the power of whole life insurance.
One of the things I get with a lot of clients, and it's not like I'm against the market or anything, but one of the things that a lot of people say, my financial advisor has done so great for me. And I say, oh, awesome. Well, when did you start working with your financial advisor? And it's always after 2008. And I say, well, every financial advisor done well after 2008 because the market has done nothing but go up. And I said, do you really want to test your financial advisor in the next 5 years? And I think a lot of people are going to really realize that, most financial advisors don't have as much control as they would like to assume. No. They're not sitting there watching the market, like making sure you don't lose money, and there's going to be, bloodbath in the markets. And with everything that's coming, to me, I think it'd be crazy to dump all your money in the stock market. I mean, that's just my opinion.
Listen, one of the greatest rules in real estate, I was having this conversation with somebody the other day, is you make money when you buy, not when you sell, right? You got to buy right. That's just a principle. I don't care if you buy a business, you buy it at a right price. You cannot overpay for things and expect to get returns. Yeah. And with all the metrics talking about this, the PE ratios of the companies are the highest they've been in like literally 90 years. Yeah. You're looking at the valuations of companies are at levels that we haven't seen since the Great Depression. And when we look at the fact that I think most people, I would encourage everybody, like, think critically, right? Look around, ask yourself, with COVID, with the Great Recession, 10, 15 years before that, with everything that's happened, with all the money printing, with the fact that, listen, just COVID alone, let's think about this. We shut the economy down. Nobody around the world worked for 6 months, for the most part. People then, and I would say the productive output of the world economy, productive output, what was actually created, not just that you got a job because government, is willing to print money and subsidize and all this stuff. The productive output was slashed to a fraction of what it was. Is that fair to say?
Yeah, for sure.
For at least 6 months, if not 8 to 12 months.
Yeah.
Fair enough?
Yeah.
And I would say even the productive output beyond that was maybe 20% cut in, even the next year after that from what's normally there. And so you don't get to like slash productive output and still have massive growth. I'm sorry. Like if you do, that's a principle that like it's going to catch up with you, right? And so if you think, I would just ask you, like I always say, align your money with your values and beliefs. Like, what do you believe about how that all played out? Does it make sense? And if the answer is no, like the answer is no for me, what are you doing about it? Does it make sense to put your money, you buy when you make money when you buy? Does it make sense to buy anything when it's at its all-time highest value? A lot of people in Wall Street will tell you, oh, it never makes sense to time the market. Go tell Warren Buffett that. Everybody likes to talk about Warren Buffett's not a market timer. He's a market timer, guys. He may not time the market, but he times valuations of companies, and he buys right. And like, actually, I'm curious. I'm curious about something.
As you're looking that up, Chris, it makes me think I've dabbled in some Forex trading in the last couple of years, and there's this whole trader psychology, and it parallels with the market exactly. Like when you're in profit in a trade, or you've got your portfolio, and like you said, you're at all-time highs, psychologically, you think everything's going good, so now's the time to continue going. We want to get greedy. We want to keep that profit going and keep making money, when in fact, like you said, it's opposite. When it's at the all-time high, you should be thinking about how can I take some profit off the table? And it's opposite of our emotions, because when the economy's bad, or we're in a trade, if we're a Forex trader and we're losing money, that's when we want, let's pull out. Let's pull all of our money out. And right now, I've got a client that her advisor is still trying to get her into the market. He's changing allocations for more risk. And I'm like, what are we doing? But it's just so captivating for people to be at this all-time high and like in this euphoria, like it's never going to change. And I'm asking this client, like, what do you think is going to happen in the future? And of course, she thinks it's probably going to go down. And do you feel comfortable about what your advisor is doing? Well, no, of course not. And it's like, that is a major problem that a lot of people are going to find themselves in. And I think that's going to compound with everything we've been talking about here. When you have, if the economy does bottom out here at some point and people are, losing 50% of their 401ks, what's the ripple effect of that on the economy when people can't buy groceries and pay for their heat in the winter? Like, it's a big deal.
It's a big deal. And the bottom line is, anybody that has debt, that has leverage, is going to get hurt the most, because those are the assets that are going to get decimated. I've got a video coming out walking people through what they need to do to get rid of, get through all this. And, the thing that I just looked up, guys, I went to ChatGPT and I asked it, what percentage of Warren Buffett's net worth does he have in cash right now? Okay. I literally I love ChatGPT. And it goes, and it literally pumps out, Berkshire Hathaway just moved $200 billion into cash. Berkshire Hathaway, guys, just moved $200 billion into cash. $200 billion. So I'm not against the stock market, guys. I'm against buying assets that are overly inflated. It's the reason I came to the Dominican Republic. It's the reason we bought a hotel down here. And because I could buy a hotel down here for prices that were a 30th the price that I would pay for the same asset in the United States. And I'm able to create the same actual cash flow per room on the hotel that I would be able to create in the United States for an asset that costs a 30th. So when you talk about cash flow, when you talk about control, when you talk about I'm able to do this with no debt, like I'm looking at this being like, don't get me wrong, I'm not saying this doesn't come with risk. I'm not saying that things can't happen in the economy. And if the US economy goes in the tank, that tourism won't go down, and that, our cash flow as a hotel won't, get kicked in the teeth as well. But we're doing it with no debt to be able to manage it, right? And to be able to manage the flow, even in a down economy, even if it would be a year and a half to 2 years, we literally have to have like an 8% occupancy rate to be solvent, right? And so it doesn't take a lot to survive, to be able to make it work. And honestly, if I had to fund that personally, I could fund it personally. You know what I mean? Like, I'm not like, But when we talk about opportunity, when we talk about, what are people doing? You got to find deals. I was looking for deals. I couldn't find deals in the United States. You make money when you buy. I wanted to go find places that I could buy that I knew I could, that I could control the outcome and the variables, even though I believe that we're going to go into something really nasty, right? And so I have a time frame for what I'm trying to accomplish, with the fund and with the hotel and what we're building, and being able to create cash flow and create a multiple and do all these things. But if I did that in the United States, I'd have to use leverage, and there'd be risk, and there would be the chance that it all implode. The biggest risk here is that it takes me another 2 or 3 years, right? And I just got to ride it out. That's the biggest risk. Which do I think could happen? Yeah, I think there's a high chance that could happen. If the economy goes in the tank, there's a good chance that things that are going to happen that'll impact everything. And I'd rather be in that position, because now I'll be sitting with no debt and other stuff going on, and probably good, decent enough cash flow enough from this to be able to buy other depressed assets around us because other people were stupid with their money, And that's what it comes down to.
Can I add something to kind of what you're talking about here, Chris? You kind of touched on it earlier too. You asked a minute ago, what do we do about all this? And it takes me back to some stuff I'd heard several years ago about in the Great Depression, and you alluded to this earlier. I heard the stats where there was 75% of millionaires at the time of the Great Depression were created because of that, because there's opportunity in struggle. And I think if we look at that throughout a lot of life, right, we go through struggles, we go through marriage struggles, we go through health struggles, we go through these challenges, and it's the refining process of life. So yes, economic struggles are difficult, they're challenging, but if you have mental toughness and you can look for the opportunities and be prepared the best you can based on your situation, there's massive opportunities coming for you to grow wealth and be positioned in a way that can, after all the storm has passed, for you to be in a much better position. You don't have to ride the ship down. You have the power to put yourself in a prime spot to capitalize on these great opportunities, because when everybody else is down with the ship, like you said, there's other places you can acquire. It's great for real estate. And there's a lot of guys that sit with money in their cash value of their life insurance or wherever they store their capital that are waiting to pounce on these opportunities that are going to be coming.
Love it. It's so true. It's so true. That's what, Warren Buffett. I love Warren Buffett. I'm not I don't know. I'm not the biggest fan, but I agree with his philosophies. I agree the fact you make money when you buy. The guy just moved. His company's just moved $200 billion into cash, guys. And that by the way, who did ChatGPT source that to? Forbes Australia. I'm gonna open this. I'm gonna share this link for everybody, so you can go check it out. It'll be fun. Open it in another tab, and go read it after. But Buffett, they just moved $200 billion into cash. That says they're looking for opportunity. They're waiting. They know the markets are overvalued. Guys, this is how Warren Buffett makes his money.
Yeah.
98% of Warren Buffett's wealth he's created after the age of 55. Okay. And why do you think that is? Do you think, I will tell you, because there's been more and more extreme boom bust cycles in Warren Buffett's life since he was 55. If you look at the economy, and you look at what's going on since the 80s, when we had, what happened in 1980 and all the way through today, it's created some crazy boom bust cycles. And he just has been the best in the world at capitalizing on them. That's what it is. People say he's not a market timer. He's absolutely a market timer. He sits on cash like he's doing now. He waits for the market to crash. He looks for and identifies opportunity. He looks for companies he can buy, assets he can invest in. He invests in those assets when they're near rock bottom prices. He rides them up, he sells them, converts to cash, and waits and repeats the process again, because the market is cyclical. It's not this linear curve that your financial advisor wants you to look at. Go look back. It's not. You have to go look back, and you have to realize, if you really want to be able to create wealth. And by the way, the good news is that if you're feeling like you are kind of behind the eight ball on planning and you're running out of time and whatever, if you're willing to be patient and you're willing to be opportunistic, you will be able to find deals that will be able to bail you out of a lot of financial issues. You need to save money right now. You need to get a stockpile of liquid, accessible capital that's guaranteed, that's liquid, that you can control, that you have access to. And then don't worry about the returns that you're getting right now. Just wait and wait for the opportunity, because the opportunities are going to come. That's my philosophy. That's how we've always done things. And I'm not going to lie, it's really frustrating. I felt like this is going to happen a while ago. And I think it would have happened a while ago had it not been for COVID. And there lies the question, was that an on-purpose kind of thing? I don't know. But
you took the words right out of my mouth.
I don't know.
Oh, man. So I said that before and somebody thought I was crazy. Like, come on, you think they did that to I'm like, man, there's a lot of data.
Bro, Fauci would never lie. Fauci would never lie about that stuff.
Yeah.
Never.
Of course not. Yeah.
Come on. So I mean, I think, at the end of the day, it all just comes down to thinking critically, get out of the news, look at the variables at play, and kind of piecemeal all the information together independently of each other, and realize what we do has an impact on the rest of the world, right? So even if we do nothing, and I think that's what that Jerome Powell is hoping, if he just gives it enough time, the metrics in the economy will allow him to reduce rates and everything. But I bet he's not sleeping very well, and I think the longer he just kind of holds pat, the rest of the world's losing patience, and it's going to catch up with us. It's going to get ugly, and one way or the other, I think my personal opinion is everybody thinks we're through this inflationary problem. My personal opinion is we're going to see another inflationary spike before this is all over. I don't know when. I don't know how long it'll take. My guess is, personally, it'll be after the next election. And the reason I think it's going to be after the next election is because nobody wants to take responsibility for anything. Right. And so hopefully Trump wins, and Sleepy Joe is out of there, but when he wins, he's going to be able to blame everything on Biden. Just like when Biden won, he got to blame everything on Trump. You know what I mean? If Biden wins, it's going to be the worst thing for the economy because he's not going to be able to blame anything on anybody. It was his fault. Right. And so that's just going to lead to more manipulation, more problems. And not to say that, there won't be manipulation if, the other party wins as well, if Trump wins. But I think it lends itself, a regime change, a power change lends itself more to being able to blame the other party and more to being able to take bigger, bolder, faster moves that are like, all right, guys, this is going to hurt. It's not my fault. I've got to bring us through this pain because, this other idiot did this stuff and it's his fault and I'm here to rescue you. But you know what? Because you guys, voted me out last time, if you had voted, I could see this already, by the way, because you voted me out last time, you got yourself into this mess. I'm going to get you out of it, but it's going to hurt. That's basically what the talking track is going to be from Donald Trump. As we go through this, he's going to be like, I warned you. You guys are idiots. Yeah. You guys voted me out and you incriminated me and you did all these things and I'm still going to help you. And because, all these, whatever. But it's going to get ugly. And I think it's going to get bad no matter what. And my mindset is one of my favorite quotes of all time. You guys, if anybody's watched the channel for a while, it's just because the ostrich buries his head in the sand doesn't mean the lion's dinner plans have changed. Right. And it's like the ostrich bears his head in the sand. If you know that an ostrich, what he can't see, he doesn't think it exists. So they bury their head in the sand because their brains are so dumb. They think if I can't see that lion, it doesn't even exist. Well, the lion's still looking and that ostrich is dead. Right. And it's the same thing with the economy right now. We can ignore it. And if we ignore it, if we ignore our problems, if we ignore our responsibilities, we may get a little bit longer. We may sleep a little better. We may have a little more fun. We may do all this stuff along the way. But eventually, the lion's going to get us, and the economy's going to get us, and it's going to get ugly. I'm a big believer that according to I guess, economic principles or whatever, I guess just philosophically for myself, I would rather take the pain and be proactive about it and identify where the problems are, and just, you know, even if I know it's going to hurt, do what I have to do and have like a controlled pain, you know? Yeah. It's kind of like if you're going to be in pain anyway, and you know you're going to lose your arm, do you want to lose your arm to gangrene or whatever? Or do you want to go to the doctor and have it amputated? Right? I'm going to go to the doctor.
Yeah.
Because if you don't go to the doctor, there's a chance the whole thing will kill you in the process through infection. So we have to do this in some sort of controlled fashion. As one financial advisor says, I know there's a recession going on, but I refuse to participate. Yeah, exactly. I mean, if you set your, like, listen, I'm not worried about the recession. Like, I would encourage everybody, like, I mean, it'll be painful from a growth perspective, right? Like when it happens, but it doesn't mean it has to be the end of the world. You know, set yourself up in a way and make sure your money and your assets and whatever, have no debt. Get rid of toxic debt. Don't have credit card debt. Don't have personal lines of credit out there that are higher interest rates. You know, if you can, like, I'm even a big believer, like, have your mortgages paid for at this point in time. Even though historically I've always said, if I can get a mortgage, I'd finance something for as long as I can, you know, whatever. That was when rates were 3%, 4%. I still would hold tight to that. So if you have a mortgage like that, that's, you know, that's a thing. You think about it this way. If we have inflation at 6%, 5%, and you have a locked in 3.5% mortgage rate, like my mortgage rate's 3.65%, you know, and we have it fixed for 30 years. And, you know, that's my best asset right now, you know, because I think as inflation goes up, every time inflation goes up, my mortgage rate stays flat. And so the purchasing power of that is better. And now I can charge more in rent. I can do all these things, you know, that's powerful. Think about it this way. I've got a 3.65% mortgage rate, and I just got a tenant locked in to rent our house for 4 years, and Nissan is paying our rent, or is paying the rent for him, right? And so, and we locked it in, and we got a 5% rental bump. So instead of selling the house, we got it rented out at a really good rate for us, and we got a 5% pay bump every single year. Now, the risk to me is if inflation goes up by more than 5%, you know, I lose a little bit. But if it stays now, inflation, if it only goes up by, you know, whatever, or 3%, or what if rental rates contract, like there is happening in some places in Florida, in Austin, in Phoenix, where my house is. If rental rates contract, then I'm really winning, you know, because I've got a locked in rate bump, right? So these are the things that you got to think about. And KCF says cash, getting ready. That's what it's all about. You got to build that stockpile of cash, man. And that's why I love whole life insurance, guys, because I shared that link above. If you're just getting here, about the video about what's going to happen with if the dollar does have a challenge, or if you're worried about that, whole life insurance companies will make the pivot. Like I could try to make the pivot myself, or, you know, or I could trust a company that's managing billions and billions of dollars, and let them manage the pivot when they think it's applicable and when they think it's appropriate. And so for me, I love the idea of having my money on a whole life insurance policy. I love keeping it there, and that I love to have that as my opportunity fund rather than just keeping it in a bank where I'm really tied into the fiat, you know, currency system and fractional reserve banking, and, you know, we're at risk of all those risks. We take a lot of the risk off the table and we build in other protections. You know, that's really what it comes down to. And so I actually, next week on Life 180, I just filmed a masterclass. So if it's your first time here, guys, I would really encourage everybody to subscribe and hit the bell. If you're already a subscriber, I'd really encourage you to go down and click on the bell and make sure that the bell is checked. That way you're notified, because next week I've got a masterclass coming out, and we're gonna do some other stuff with this. But I figured just for everybody on YouTube, I wanted it to be here, just to be accessible. It's a 5-video masterclass, and it's going to walk through why whole life insurance is such a powerful asset right now. And it literally is going to walk you through this problem of thinking about your core values thinking about your beliefs, thinking about everything you want to accomplish in your life, identifying the challenges that you're looking to solve in your own personal financial world. And it's a 5-video masterclass that goes through it, and it walks you through all the way from identifying your problems, getting clear with your core values and your mission and your vision and all these things, thinking about the different ways that you can use life insurance, talking about the cost of waiting to really get you to see the value of starting as soon as possible, and then talking about how you can take all that, roll it in, operate more financially efficient to accomplish your goals. Because I think too many people are sold that thinking about the rate of return is the most important thing they need to do, when in fact thinking about the actual results, what I call the rate of result in your life, is the most important thing. And so what are you doing with all your money, not just your investments, but what are you doing with all your money and with your actions and your behaviors and your strategies? What are you doing with everything to become who you need to be to actually get the result in your life that you're after? That's what it's all about, So anyway, that's it. We're on an hour now. So I think, you guys got anything else? Anybody have any questions, comments, whatever?
Drop it in the comments.
Matt, you got anything before we go?
No, I think we just buckle up. That's all I get to say.
Fair enough. How about you, Jeff?
Yeah, I think we covered it all really well. I mean, I really think that, we outlined the problem. I think we outlined the solution. We shared some specific points that we can take into application in our life and make the best of the situation. And I think, comes back to like you just finished up there with Chris. Got to work on yourself, got to make yourself better, got to expand your income, expand your control over what you're doing. And that's really the only thing we can focus on. You can focus on all the external things that are out of your control. You can focus on what you can do, bettering your skills, bettering your network, sharpening that tool of yourself, getting better. Yep. And that's the best thing you can do.
Robert Hastings, pay bigger premiums. Exactly. So, Jeff, read this comment and respond to it.
Just heard this from a prospect. I think Dave Ramsey is incomplete and hypocritical. Yes, take control of your entire finances until step 7, which in his baby step 7 is, what's the last one? Giving. I think step 7 is giving. And then give it to someone who's making money off of you.
Probably working with a financial advisor or something like I don't know. I don't have step 7 in front of me.
Yeah, I don't either. I've done some content on it on Dave before, but let me reread it. So yes, take control of your entire finances up until step 7 and give it to someone who's making money off of you.
Yeah.
I guess I'm not.
Yeah, I mean, I think that probably has to do with like investing money in mutual funds. Is my guess, is when you're like really investing a lot of money into mutual funds, and when you do that, you're putting yourself in a situation where, I mean, first of all, mutual funds, when you give your money to an investment manager, I think it was Kiplinger, or no, it was Morningstar did a study that was 94% of financial advisors after fees don't beat the S&P 500. 94%.
Yeah.
And so like, it just goes to show, there's absolutely a massive level of hypocrisy with Dave Ramsey. I would say the greatest level of hypocrisy with Dave Ramsey is the fact that, he tells you to invest in mutual funds and that's how you get rich, when he's made all his wealth as a marketer, as an entrepreneur.
Right.
Like he didn't become wealthy investing in mutual funds, yet he's trying to tell you to become wealthy investing in mutual funds. That's the biggest hypocritical element of any financial influencer online, period. So he's a good marketer though. He's a great one. He's got it down. So, all right, guys. Well, thanks for being here. If you haven't already, like I said, make sure you subscribe and hit the bell that we're notified when the masterclass videos come out next week. They are coming out over the weekend. Got a couple more good videos coming out this week as well. I've been putting a lot of time into a lot of content because I am actually going on a little bit of a road trip. Get to take a little bit of a break. I'm going to go play in the World Series of Poker, which is going to be fun. I need to do that every single year, so that's kind of part of my world. Gonna do that. So if anybody's in Vegas the first week of July, let me know. We can connect. But aside from that, I guess I will talk to everybody later. Have a blessed, inspirational day. Thanks, guys.